All right. Hello, everyone. My name is Doug Earthman, and I'm with 2D Investments. I'm here with my partners, Mickey and Seif, to present to you about our short-term rental investment fund. Mickey and I are going to spend a few minutes introducing ourselves and telling you a little bit about 2D Investments before we turn it over to Seif with Techvestor, who we've partnered with, to tell you about this super exciting opportunity to get into the short-term rental space as a passive investor. So really quick, a little bit about myself. Again, I'm Doug Earthman. I was born and raised in Memphis, Tennessee, went to Ole Miss where I got a degree in engineering, and I have a background in environmental and geotechnical engineering, still currently working in that field today. But I'm also in the real estate investing world. I've been married for 5 years to my beautiful wife, Brittany, and we have two amazing children, a 2.5-year-old boy named Andrew and a 7-month-old girl named Georgia Kate. One of my many hobbies outside of hunting and fishing and anything outdoors is training and competing in triathlons or any sort of endurance racing. I actually got connected with my partner, Mickey, through one of my teammates, who is Mickey's stepson. Mickey and I hit it off quickly and started brainstorming for what is now 2D Investments. I'm going to turn it over to Mickey to let him tell you a little bit about himself and give you his side of the story. Mickey?
Thank you, Doug. Hello, everyone. Mickey Bernstein, the other side of this partnership, 2D Investments, and I am really glad to be part of this. I was a dentist for 40 years and retired. I was looking for something fun to do and met Doug and decided to go all in and start my third career. Worked as a consultant for a while as well. I'm also a endurance athlete and ran marathons for 30 years. I have a great wife, Diane, and 7 children and 14 grandkids. So really looking forward to helping everyone build your wealth and getting to know you better.
All right, thanks, Mickey. So at 2D Investments, we aim to break down the barriers of entry to real estate investing. And we do that by helping educate investors, and we provide a platform to invest in alternative assets. So real estate investing been getting a lot of attention lately, but why? Why real estate? So most of you have probably seen this first statistic or a quote that 90% of the world's millionaires have been created through real estate investing. Next point, there's a lot of volatility in the stock market right now. I don't know about you, but it is not the place that I'm comfortable placing my money right now. There is also, the traditional methods of wealth building just don't seem to cut it anymore. Contributing to your 401k is just one piece of the puzzle, but adding real estate to your portfolio is a paramount to building your wealth at this point in time. It also creates passive income streams. Who does not like mailbox money? And another thing that's getting a lot of news right now is inflation, and real estate helps hedge inflation. And also, you can get tremendous tax benefits through depreciation and using the 1031 exchange to defer paying capital gains. So now what's the difference between active and passive investing? So active real estate investing is you're sourcing, buying, managing, and operating a property, which also requires time, knowledge, experience, capital, and most of all, it requires a large tolerance for risk. A lot of people call it managing tenants and toilets, which, takes time and a lot of energy. Doesn't sound very appealing to most people. Passive real estate investing, on the other hand, is purchasing shares or units of a property, which requires no time commitment and no work, no tenants and toilets. So you have active investing, time and work. It can also be extremely profitable, but you're also taking a lot of risk. Passive requires no work or time. You get to reap the rewards. So what is a syndication? So syndication is a vehicle in which you can passively invest in real estate. So it's pooling money together to take down a large real estate project that an individual typically couldn't do on their own. You pool investor money together to meet the equity requirements of a large project, which typically produce larger returns. So there's two components to a syndication. You have your general partners, which is the active investor doing all the work and taking the risk. And then you have your limited partner who brings capital to the project, and your risk is limited and you're a passive investor. So why 2D investments? We simplify a complex process for you. We're doing all the legwork. We're doing the due diligence, and we're managing the investments. And we're going out and sourcing these investment opportunities and bringing them to you. We also provide education. We also have a portal on our website that's very user-friendly and streamlines the investment process. So now it's my pleasure to hand it over to Seif, who is the co-founder and CEO of Techvestor, who we have partnered with on this incredible investment opportunity. Seif?
Thanks, Doug. Thanks, Mickey. We're excited to partner with y'all and bring short-term rentals to the masses. It's been a historically difficult to access asset class because of its lack of scalability and lack of diversification. And we're solving that with a little bit of technology and some really great talent we have on our team. So as Doug mentioned, I'm one of the co-founders at Techvestor. Previously, I was with Facebook scaling that for the last 5 years, in addition to building a family of my own. So congrats to you, Doug, as well. And, you know, short-term rentals, we've seen a bunch of shitty of them over the years. But for us, we wanted to build a product and an experience based on a lot of our early investor experience and traction that investors could relate to. And so what I mean by that is people wanted to get into the business, but they didn't want to do any of the work, right? And that's exactly why syndications exist, where you don't want to be the manager, you don't want to be the operator, you don't want to be the landlord, you don't want to be the designer. So you can invest in an asset class of short-term rentals for the first time, or one of the first times, in a super passive way, right? Your minimum investment with 2D is going to be 50 grand. And you got the capital, but you don't have the time, the energy, the know-how, or maybe the want to actually operate this yourself. In fact, it's very common. I'm an operator in short-term rentals, and I'm an expert at operating in short-term rentals. At least that's what I tell my wife. But on the other hand, you have other asset classes like multifamily and storage where I'm not an expert in, right? So what I do is I become a limited partner in investments like those, right? Because I'm not the operator there, because I lack the time, energy, know-how, or want. So you might be a W-2 employee, another real estate investor, and you're like, well, I want to get into this asset class, but now you don't have to do any of the work. So it's passive, you're getting your quarterly distribution, you're getting all the tax benefits, all the equity growth that comes with it, because you own this directly, right? It's as if you owned it directly. There's no difference, right, in terms of tax treatment. And the two favorite things that I have about this offering is zero liability of loans and lending. Yours truly signs on all the debt. In fact, for Christmas last year, I sent my wife a little Christmas card, a little under the tree. I was like, honey, we have $30 million in debt. How do you feel? And she could not be more excited after I explained to her how that meant, because it's good kind of debt, and we'll get to that later. But you also get instant diversification, right? 100 plus projected properties in the portfolio. You cannot buy any sort of scale or diversification in real estate with 50 grand, right? Anywhere really in the country. You're not going to get enough juice for your bang there. So that's a great one as well. Over these next 5 years, which is the projected hold roughly here, what we're going to do is we're going to buy a bunch of single family homes across about a dozen markets in the United States. We're going to design them, furnish them, operate them as high-performing short-term rentals, which is going to produce significantly better returns versus, say, long-term rentals. We're going to do all the hard work. We're then going to package them up nice and pretty as if you're going to Costco and you're going to buy a 12-pack of muffins that you're probably not going to eat, but you want them. And we're going to eventually sell them off to an institution who wants to buy the 12-pack. And the reason they want to do that is because they want to buy 12 of them or 100 of them or 500 of them instead of one at a time, right? And because of those types of things, we're going to get the premium that they're going to be looking for in that stabilized yield and eventually exit the portfolio roughly over these next 5 years. Now, it ain't our first rodeo. We've done this before. So last year's fund, we raised about $37 million, close to about 80 properties. We've driven about 71% more revenue than our competition and 41% more occupancy. Now, the reason that this matters, and we'll talk about it a little bit later, is that 90 to 95% of the time, our competition in this asset class isn't BlackRock or Blackstone or some institutional operator. It's a mom and pop operation or Grandpa Bob down the street who's got IKEA furniture in his garage and he's calling it a bedroom. And because of that, we're able to really outperform by doing really simple things. I don't want to make it sound simple, but it's not that hard to outperform when you have the level of caliber of talent, technology, and traction that we have here. We've also performed 8 exits full cycle, where we've exited those for between a 5.4 and a 6.5 cap. For those of you who are not familiar with cap rates, the lower the number, the higher the multiple. So the lower the number you go, it's actually a good thing. We've underwritten for between a 6 and an 8 on exit, and we're getting that 5.4 to 6, and generated about a 42% average IRR, which is pretty good, right? For relative to a lot of opportunities in the last couple of years. So we've never had a capital call. I want to kind of start there, right? Some people have asked, well, what happens if things don't go well? Are you going to come and ask me for more money? So in our docs, we literally legally have no right to ask you for a capital call. You will not have that. The general partners, myself, Sam, and Sabrina included, will be, in fact, the ones who put up any capital call capital, right? Kind of say that 10 times fast. But that's the idea that we're doing there, okay? We're already operational. We've always been cash flow positive. And this bell curve that you see here gives you a great idea of how real estate works. When you invest in real estate, it's not a get-rich-quick game. It's a get-rich-guaranteed game, as the saying goes. And the reason for that is when you invest, we got to find it, design it, furnish it, launch it, stabilize it. So think of it like a sandwich. You want the whole meat inside and everything inside that sandwich is what your years, 2, 3, 4 are going to feel like. And then year 1, you got this ramp, and year 5, you got this ramp down. That is, in short, what the bell curve represents. So today, we'll talk a little bit about our operating team, which, I might be a little bit biased here as a leader, but I think we have the best one in space. Key advisors that we have, the technology that we built, and what we're going to do in terms of protecting, scaling your money, as well as the asset class and some education. So as a reminder, the idea here is to 1.8 to 2x your money every 4 to 6 years. Great cash flow yield, do it passively, have that diversification, and get those tax benefits. And the asset class of choice is short-term rentals. Many of you may know them as an Airbnb or Airbnbs, where you're getting significantly better cash flow because we're renting them by the night, by the week, or by the month, usually in that case, rather than on a 12-month or an 18-month lease. You get better tax benefits, but more importantly, our society prefers them. And let's talk about the data, right? 3 times the usage over the last decade, certainly influenced by the permanent shift in behavior that the pandemic brought, whether that's remote work, flexible living. I mean, can't tell you how many times my wife and I will get away for a few days just because I can. And we're not there necessarily to vacation. I'm doing my work, taking my meetings, and going out to dinner, right? Just because we're in a new space and a new environment. So demand and the business itself of short-term rentals, half of which here of the $150 billion industry happens right here stateside. And we're investing right here on US soil to do that. Booking activity is up year over year. Not only year over year, but it's not a COVID anomaly year. I think there's some myths around short-term rentals where they're like, well, they're going to go back down, right? Because COVID brought this, and now this is the only time people are traveling. Well, the data doesn't suggest that. The data suggests that even going back to 2019, we're having the best year ever on record. In fact, demand is also up on the best year on record in January and December, and we expect that to continue. Even more importantly, Demand pacing is up, meaning people are not only booking more often at a higher clip, they're doing it more in advance than ever before because they have the flexibility to do so and a want to do so. Now, I mentioned this earlier, but about 90% of the time, our competitions are mom and pops, which they lack the management, the design, the scale, and the technology, and really the entire infrastructure that we have. We don't drive the performance we have because it's an accident. It's because we do it full time, we understand it, we make data-driven decisions, and we have an incredibly high caliber of talent on our team, which when you're investing in a real estate syndication, many good operators will tell you, it's not about the deal, it's about the person. Because navigating whatever comes up is half the battle, right? And the other half is good debt, which we'll get to that later, but we got a bunch of that too. So a live look at performance of our first fund, as you can see, quite good. This number over here and, having this nice up and to the right, as they call it, is nice to see. We're performing really well, right, in our first fund. And this is an opportunity for us to replicate exactly the strategies we did in fund one for you to invest in our second fund, which is going to have nearly identical performance, we hope, if not better. But we're coming off of the foundation of all the learnings we had, and we expect this to be a faster ramp, a faster experience, and better returns. And we've done it not once, not twice. We've owned properties personally, professionally. The data tells us we usually do better than what we underwrite for. I'm sure in the deck that Doug and Mickey will send out here, you guys can click around, see some of our properties, walk around them via the Matterport, all those types of things. So I talked a little bit about myself at the beginning, but we wouldn't be here today if it wasn't for my incredible partner, Sabrina. She was previously with Apple, took AirPods, or the first generation AirPods to market in $1 billion product line at Apple. She oversees our operational and design infrastructure, while I read our talent, financial, and portfolio infrastructure. And we both wouldn't be here today without an incredible team as well. So Sam is our head of capital markets. He's done nearly $1 billion worth of real estate transactions. Mick is our head of asset management. He comes to us from Vacasa, where he ran portfolio management there. Vacasa is the largest short-term rental management company in the country and the only company to ever go public. So bringing him onto our team was a big win. You have people like John, who is our head of data and is literally known as the Airbnb data guy. That is his handle on Twitter and on TikTok, as he'll let you know. And then you got Josh Lewis, who would previously scaled D.R. Horton's funds, and D.R. Horton's one of the largest single-family operators in the country from a build perspective. We've been featured in a couple places. If you're the kind that wants to go do your diligence and listen and read, I think what we're doing is quite interesting. The media seems to find it interesting, at least. So we encourage you guys to go look at some of those types of things. But we've also added some really great white hair on the team, as I like to call it. Scott's the founder of AirDNA. Jamie's the VP of research at AirDNA. They're the largest short-term and most trusted STR data and analytics firm in the country. People like Rob, who's the host of the Bigger Pockets podcast. Laszlo, who's got a resume that's incredible. I mean, I don't even know where to start, everywhere from Citadel to Uber to Realtor.com. This team, the people, the connections we have, and the infrastructure allow us to execute flawlessly, in our opinion. But if that wasn't enough, we built our own software, right? Our software allows us to underwrite over 100,000 properties a month. You ask us, well, how do we know what we're going to buy next and where we're going to buy it? Well, our software does a lot of the heavy lifting up front. 94% of the time, the deal sucks, but we never look at it. But those 6% of the time the deal looks good, our head of acquisition and our humans are making decision-making on that deal. We are not a technology company. I want to be very clear, because what we've seen perhaps people get confused with is, well, we're just buying, I buy like Zillow or Opendoor. We are not a technology company that does real estate. We are a real estate company that happens to build technology, and those are two fundamentally different things. Our humans are who make every single decision guided by data. And our software allows us to understand what to buy, where to buy it, how to finance it, and everything around that market from a sustainability perspective. And quite honestly, it helps us scale. I mean, we grew to over 12 markets in our first year and will continue to grow where it makes sense. And half of these markets typically are going to be around destinations like beach, mountain, et cetera. And you got metros like Scottsdale and Memphis, right? And Doug, you said you grew up in Memphis. We got a couple properties there. In fact, I saw our newest property today in our first fund go live in Memphis. Gorgeous home. I'll have to send it to you after. But you get all this diversification with a single investment, right? Where we're making all the decisions, figuring out where to put the money, where to buy, all those types of things. Underwriting on a 16-point strategy. So while we look for a lot of things, and I'm sure y'all can read the list A big thing we look for is that ADR, that top left one, the $200 number, because we don't compete with hotels. Most of our properties are 4 bedrooms and larger, are well amenitized with pools, hot tubs, golf simulators, gaming lounges, stock tank pools, places where a group of 6, 8, or 12 people want to take either as adults or as a family. They're not partiers. That's the type of avatar that we're building for. In fact, we're seeing nearly double the ADR across our portfolio today. We're also the only vertically integrated company in the space, meaning we find, design, furnish, renovate, operate, and disposition all in-house, which gives us an incredible innate perspective as to what to do, when to do it, and really no scalability challenges. We own the infrastructure. Because we own the infrastructure, we can grow and do without a bunch of red tape, right? And red tape slows a lot of things down. But lastly, the industry's problem, in our opinion, is property managers and owners, right? Because there's a conflict of interest with like what good performance looks like. In our fund, we as a collective community are both, right? We own the entire stack through our OpCo and through our PropCo. Design and data are two things that are incredibly important to us. And let me show you how they kind of come together. This is a property in our first fund in Scottsdale. What's unique about this property, it's one of the few short-term rentals that were already a short-term rental when we bought it, right? 99% of the time, we're going to buy properties that are not existing short-term rentals, and then we're going to turn them into it. This, on the other hand, was an existing short-term rental. It was doing about $140,000, $145,000 in revenue per year for the last 3 years before we bought it. It just wrapped up its first full operational year and it clipped over $211,000. Okay, now for anyone who's doing some math there, that's about a roughly $70,000 increase. Based on some element of a cap rate, we can argue what it is. That's at least a $500,000 increase in value because of a great operator who came in, had cohesive design, better revenue management, better property management, and boom, and that's one property. Okay. Or this industrial-like property in the Poconos, which looks industrial now, but used to look like Grandma's Cabin. There's nothing wrong with Grandma's Cabin, right? But in this case, this market, this avatar, this did not exist, right? And the avatar was looking for it based on the data. When I say avatar, it's the guests that we're hosting. Or our Barbie-inspired pink home that hosts a bunch of bachelorette parties. In fact, this home was so well designed to caught the eye of CBS's hit show Staycation, of which will be featured on later this year. Okay. So everything from including the model in the photos to the design to the color scheme was all driven by data and design. Or in Memphis, stock tank pools and modern amenities, right, that allow for large groups of families to comfortably stay without feeling like they're staying in a place that's uninspiring. Or more modern like homes in the Poconos, cabins that you walk in and they look and feel like a modern home because it's what the avatar looks for. So, you know, the design and the operation is great, but let's talk about the numbers. Doug, why don't you walk everyone through here a little bit about what the investment kind of looks like?
All right. So what we have here for you, our minimum investment amount is $50,000. As Seif referred to earlier, we're looking like a 5-year projected hold period. There is the bell curve that he referred to where there's ramping up and ramping down. So there could be exit starting between 4 and 6 years. We will be passing through 100% of the depreciation through our entity to our investors. So that's another benefit we'll give. We'll have quarterly distributions. You're looking at a 8 to 12% cash flow, your cash on cash return, 17% internal rate of return, and diversified over 100 properties.
Whoops. So the pref here, the pref here and the split are incredibly generous, for lack of a better word. I was joking with Doug and Mickey right before we started this that they took me out to the barn and were like, you know, we need some better terms for our investors, and they got you guys, right? So, you know, if you were to come to us direct and say, hey, I want to invest, we'd give you an 8 and 50, right? Because you're writing a minimum check. Because 2D Investments is aggregating capital through its community, and you're a a member of that community, and they're going to write a $500,000, million, or $10 million check. They've negotiated better terms, which they've passed on to you guys as LPs. And I think this is a really strong indicator. If you look at this right here, is generally what the minimum looks like, what the next 5 years look like, the projected equity multiple, including their fees, which even with their fees, you're getting significantly better returns there. And those fees are well worth it because they've negotiated these better terms for you. So obviously you can pause the video, watch it. I'm sure it's included in the deck that they've provided. But any other commentary you want to add here, Doug?
No, I think you got it. Appreciate it.
Yeah. So let's talk a little bit about taxes, right? Because everyone says, well, real estate's got an incredible tax benefit. And you're right. It's called a cost segregation study to take what's called bonus depreciation. And we will be doing that across our portfolio. And we're projecting roughly in that 20, 30, 40% range over the first couple of years based on whatever you invest. Now, none of this is tax advice on my part or Doug's or Mickey's. And it's not guaranteed. You may not qualify based on your current situation. But what we find is that most people do qualify, but you are responsible for filing your own taxes, and we'll go ahead and issue you a K-1. Now, outside of the boring talk, talk about the cool talk. You get to use the portfolio as an owner. You're an investor, so stay like one. We hope you do. Use them 10 to 30% off across the entire portfolio. It does not affect the investment itself because you're booking direct. You're bypassing platform fees on Airbnb, whether it's on the guest side or the host side. So everyone wins, and no one's going to take care of the property better than an owner. So we encourage you guys to do that. Now, I talked and joked a little bit about debt earlier. Debt is the number one reason why real estate fails or operators lose their shirt. And it was incredibly important for us to position our investment and therefore your capital in a way that we would never be what's called a forced seller. So when we buy our homes, we're typically putting 20 to 25% down. We're adding significant value through renovation, through floors, kitchen, bathrooms, et cetera, including incredible amenities. And then I'm sure you can look at some of the photos and get a sense of what those look like. And most importantly, we're adding fixed rate debt. All of our debt is fixed for the next 30 years, including most of which is fixed on an interest-only period for the next decade. So we will never become a forced seller. If interest rates come down, we can refinance and extend and continue there. Now, you might ask, Steve, why do we need 10-year debt if it's a 5-year hold? Well, things sometimes don't go to plan. And let's talk about that. Now, we're projecting a 4 to 6 year hold. But what happens if 5 years from now, God forbid, something's going on in the world and we're like, exit right now is just not ideal for a lot of reasons. If you're in a commercial property, say like multifamily, like how rates doubled over the last 12 months, you're shit out of luck because you got to refinance or sell or take a loss unless you bought a rate cap. In our case, we just hold. We're okay. We're cash flowing. Where you have a high passive income investment. We're okay. If we got to hold a little bit longer, we will not lose that capital because of debt, right? And that's a huge value here. And even the type of debt that we're getting, you would be hard pressed to go get on your own because we have exclusive agreements to get our debt on short-term rental investing property because of the scale and institutional operation that we have, right? So all that being said, it's not 08. And the reason I bring this up is back in 2008, nearly 90 or 95% of the people who lost their shirt had variable rate debt. People always talk about poor lending where there was poor lending, but it wasn't because people took out bad loans. It was because banks gave bad loans that happened to come due under a variable rate at a bad time. And therefore, as an owner, you only had one option: sell. You couldn't refi, you didn't have any equity, and you had to sell. And when you sold at a loss, right? So all of those types of things, just a reminder, is we're not an 08. In fact, the borrowers today are significantly better. They're better equipped, better capitalized in nearly every way. However, it's a great time to buy. We've seen price compression come down, but we've seen revenues increase. That's a great conundrum to be in. If our revenues are going up and we can buy that same $500,000 property that we're buying at $450,000, our price to rent ratio has got significantly better. So that's why we're really excited about now as an opportunity to buy while everyone is kind of sitting on the sidelines. And remember, because of our investment strategy being as a short-term rental, these properties pencil significantly better for us than the alternative, making them a viable acquisition target. So a question I get often is, can't anyone do this? My short answer is, I'd love the competition. And that's to say, it's not easy, right? We have a infrastructure, operational, team, technology, and everything in between that gives us a massive leg up on the competition. So that being said, we built something that for you as an LP in the fund with Mickey and Doug, you have a really great scalable option, which is, a singular investment to get exposure to this asset class that doesn't really exist elsewhere, right? An incredibly easy to use experience through your investor portal, right? And everything that comes between. So if someone wants to invest, Mickey, can you help us understand what those next steps look like?
Sure. And thank you, Steve. As you could tell, I've been on this earth a lot of years, and I've been in real estate, 40 plus of them, including apartments and rental houses and an industrial park and condos on the beach and more. And I made us pretty good money doing that, but it was work. It was hands-on. And then I came across this, and this is quite easy. All you really have to do is understand the documents and ask the right questions and be ready to invest. So the bottom line is, whether it's in real estate investing or whether it's in dentistry, is trust and relationships. And we take your trust very seriously. And we know we got to earn that trust. And we're going to treat your money like it's our own. And we're very cautious how we help you invest it. And we're respectful that our clients are putting their financial future in our hands, because we know that money is your kids' college education or their wedding or your retirement. And we're never going to take that for granted. So it's our role to perform complete due diligence on each developer and project on your behalf. And we're confident that Techvestor, with Steve at the helm, is a great company. And we feel that STR Fund is a safe and profitable investment. And we feel this business is about relationships and trust, and will never stray from that value. So the next steps are: one, go to our website and register for Investor Portal. And if you would like to move forward while you're there, soft commit in the Investor Portal. 3, if you would like more information or have questions, please call, text, or email us. We'll give you my and Doug's contact in just a next slide. And be sure to like and follow us on social media. So there's Doug's and my contact information in the social media, and also be sure to enroll in our video subscriptions with YouTube and Spotify. Thank you.
Cool. Thanks so much for having me, Mickey. Thanks so much for having me, Doug. We're incredibly ecstatic for this opportunity to work with you guys and your community. And if there's anything we can ever do in providing education for yourselves or for your community, or any questions, feel free to throw us on a thread. We'd be always open to continuing these conversations.
And we thank you, Steve. And we really appreciate everybody staying with us tonight, and look forward to talking to you and hearing from you. Thank you. Good night.
Thanks
Thanks,
everybody.
everyone.